Lander from Standard Chartered Bank to talk to us just about that. Steve, hi, good to have you on the show. Good morning. Thanks so much for making time.
Always a pleasure.
What was your read-through of the Fed minutes that we got overnight? Expectedly hawkish?
Well, I'd say mildly hawkish. The numbers hadn't really turned by the time the FOMC meeting came around at the beginning of November. So it would have been looking at the subsequent data had they come through as a really dovish kind of statement because inflation was weaker, activity was weaker, and so on. What I took away was actually quite a divided Fed. That many of the statements were kind of factual. Several saw weakness or risks of weakness. Several saw risks of strength. But there seemed to be little consensus on which way things were going. But I think subsequently with the weak inflation numbers and with some indication that the economy may be weakening, the actual stance may be a little bit more dovish than came across through the minutes.
So what is next now? Because what markets want, Steve, some would say, is predictability. Are FOMC meetings throwing enough and more light in terms of predictability of interest rate curve?
Well, we've gone from debating, whether they're going to hike once or twice more to being pretty confident they're not going to hike and debating when they begin to cut. I think that's about as much predictability as you get. What I think the risk for markets is that, the cuts that are priced in are really contingent on the economic data weakening, that the unemployment rate keeps going up, that non-farm payrolls keeps going down. We haven't changed our forecast yet that the Fed begins to cut around mid-year because we're waiting to see more concrete evidence that the economy is indeed slowing down. Were that evidence to occur, we'd have to take it on board. But I think that for now we've seen the reversals in the past, and we're a little bit cautious about changing our views.
Outlook, Steve, on the inflation trajectory, the fact that there are worries looming large that it could continue to remain stubborn as they've described it or continue to move higher. Would more need to be done down the line, according to you, in order to alleviate the inflation concerns?
No, we don't think that they have to hike more. I think that the risk of a hike is sort of further down the road. That say inflation continues to come down, but stalls at around 3.25 and just isn't going anywhere, not going higher, not going lower. Down the road, the Fed might say, look, we have to do another hike or two to get it back moving down towards where we want it to go. So I think I don't think there's a risk or a big risk that it's going to explode. But I think that there is a risk that it could stall. And if it did stall, the Fed might have to do more hikes. That's not our forecast, but it's certainly a risk scenario.
Taken, Steve. On that note, we'll let you go. Appreciate you making time and speaking with us. But let's continue with the theme of the